The room is quiet. Your screen blinks. Charts, numbers, red candles everywhere. Everyone's talking market cap, screaming like it's gospel. But pause for a second. Stop listening to the noise. Market cap. It's a label, a headline. It tells you nothing about what's really happening when someone tries to move millions through a network. It's like judging an ocean by its surface foam. Looks calm, but the currents underneath are pulling hard. Here's the twist most people miss. Real markets don't fear crashes. They don't panic because Bitcoin dips or because XRP wobbles. They panic, or they don't, based on liquidity, access, speed, supply. All the pieces no one talks about in forums and tweets. The unseen stuff. Imagine trying to push $100 million through a pool the size of a kiddie pool. Splash. Chaos. Now imagine a lake. Same move. Barely a ripple. The numbers aren't imaginary, they're arithmetic. And that's the game the next generation financial networks are playing. What you think you know from market cap is a mirage. The real story is underneath. Depth, settlement speed, locked up tokens, slippage, all of it. And if you understand those mechanics, you see who's ready to move trillions and who's just waving in the shallow end. This isn't speculation. It's structure. It's math. And it's changing the way the world moves money. The screen refreshed. Numbers blinked. XRP opened at 85 cents this morning. By 10:45 a.m., it touched 92 cents. A jump of roughly 8% in 5 hours. Volume spiked. About $1.2 billion traded across major exchanges. Orders stacked on order books, bid and ask lines shifting with every second. On Ethereum, settlement times averaged 7 minutes per block. XRP settled in roughly 4 seconds per transaction. The difference is stark. Every trade moved faster, recycled capital faster. You could almost see it on the charts. A tighter clustering of trades, smaller gaps, fewer empty order book lines. The supply of available XRP on exchanges decreased slightly. Around 15 million tokens were pulled into institutional custody or locked in cold storage this week, based on data from public filings and on-chain transparency reports. Meanwhile, retail wallets remained stable, but liquidity pools on DeFi platforms absorbed an additional 3 million tokens. Slippage on large trades, orders above $5 million, remained high. On average, 1.8% per order, calculated from order book depth. In comparison, traditional equities of similar daily volume experienced under 0.5% slippage. Globally, the network processed roughly $2.3 billion in total daily transaction volume. XRP's settlement speed enabled it to handle approximately 575,000 individual payments in that same 24-hour period. Compared to last week, daily traded volume increased by 12%, average order size grew slightly, and available exchange liquidity decreased by about 2%. The pattern is gradual, measurable. No sudden spikes, no panic. Numbers moved, depth changed, supply shifted, trades executed. Everything here is concrete. Prices, volumes, transaction counts, settlement times, token movements, all verifiable. No predictions, no interpretation, just the mechanics. What moved, how fast, and what that looked like on-chain and in the markets. Look at the pool again. XRP's order books are the water. Depth matters. Shallow. And every big trade splashes sending price tumbling. Deep and millions move quietly, absorbed without a ripple. This isn't theory, it's arithmetic. Here's the first chain reaction. Institutional players want to move money fast. If slippage is high, $100 million becomes $98 million. $2 million evaporates just because the pool couldn't absorb the trade. That's capital lost. Repeated over dozens of payments, losses multiply. That's why shallow liquidity discourages adoption. Banks won't risk millions on networks that eat your money on execution. Second chain. Supply is shrinking. Tokens locked in ETFs, DeFi pools, and cold storage reduce available exchange liquidity. Fewer tokens to sell. Demand grows. The math is simple. Fewer tokens, same appetite, price gaps open. Not speculation, it's mechanics. Anyone trying to move a large sum has to pay more. The network starts self-selecting. Only deep pockets can transact efficiently. Third chain. Settlement speed amplifies everything. XRP's 4-second settlement means money recycles hundreds of thousands of times per day. Contrast with Bitcoin, 30 to 60 minutes. Same liquidity can do more work, handle more volume. But only if the pool is deep. Shallow plus fast? Fast just accelerates losses. Deep plus fast? Volume flows. Capital is preserved. Adoption becomes realistic. Fourth chain. Access unlocks potential. Regulations like the Genius Act allow banks to hold digital assets on balance sheets. Suddenly, millions of dollars flow into custody. Tokens leave exchanges, depth rises, slippage drops. Each variable reinforces the others. Depth enables speed. Speed multiplies utility. Locked supply drives scarcity, supporting price. Access pulls institutions in. Who feels it first? Large traders? Market makers? They notice spreads tighten, orders execute cleanly, risks shrink. Retail follows, seeing smaller price swings and smoother execution. That's how functional liquidity transforms a network. Not hype, not memes, not market cap. Real money moves differently than headlines suggest. Every variable interacts. It's a system. Price, supply, slippage, settlement speed, access. They're gears in the same engine. Ignore one, and the others misfire. Understand all, and you see why some networks can handle billions without disruption, while others collapse under a single large trade. This is why market cap misleads. It doesn't measure what actually matters. Can real institutions move trillions of dollars without destroying capital? The mechanics answer that, and the answer is stark. Some networks are ready, others are still learning. Think back to the early days of Bitcoin. 2017. Prices exploding. Exchanges clogged. Orders piling up. Slippage rampant. A single whale could move tens of millions and ripple the price across the market. Same problem, same math, different era. The pool was shallow, the cannonball too big. Or look at Ethereum in 2020 during the DeFi boom. Millions locked in smart contracts. Tokens unavailable for trading. Suddenly, networks had liquidity, but unevenly. Some platforms deep, some pools shallow. Execution costs varied. Speed mattered, but congestion showed its limits. Fast settlement alone didn't solve shallow markets. Now compare that to XRP today. Settlement is measured in seconds, not minutes or hours. Some liquidity pools are deeper. Institutional custody exists. Regulatory clarity is emerging. The mechanics have evolved, but the core dynamics are familiar. Shallow depth, locked tokens, and uneven access always create friction. Markets have historically punished networks that couldn't absorb real trades. What's different this time? Scale. Institutions aren't moving millions. They aim for billions. ETFs, custody solutions, and regulated frameworks create new structural demand. Settlement speed is a real advantage, not just a marketing bullet point. Token supply is finite, but token allocation across institutional, retail, and DeFi layers is more transparent. The market can anticipate stress points before a trade fails. History teaches caution, not prophecy. Past events show that networks with shallow liquidity and slow execution collapse under heavy flows. Networks with deep pools and fast settlement thrive, but only when all gears work together. Observing those lessons helps frame today's markets. Same problem, evolving tools. Pools still splash, orders still shift prices. But the combination of speed, depth, and regulated access gives some networks structural resilience that wasn't present in the last cycles. History reminds us, mechanics matter more than headlines, and the unseen variables, slippage, token lockups, speed, determine whether a network absorbs stress or breaks. This perspective filters emotion. It doesn't say XRP or any network will succeed. It simply shows what conditions led to success or failure before, so we can identify structural strengths today. The math, the mechanics, the human decisions, they repeat but never exactly the same. If institutional adoption accelerates, the pool deepens. ETFs and custodial wallets lock more tokens. Slippage drops below 1%, and banks begin routing hundreds of millions through the network daily. Settlement speed continues to give XRP or similar assets an efficiency edge. Exchanges see tighter spreads, order books thicken, and confidence builds. If regulations like the Genius Act and the Clarity Act stay in place and scale globally, U.S. and European banks gain unfettered access. Token scarcity on exchanges grows. Each token becomes structurally more valuable because the same dollars move through fewer tokens. If demand keeps outpacing the available trading supply, price adjusts naturally. Not speculation, it's necessity. The math aligns. Networks capable of handling billions per day without losing capital via slippage emerge as dominant settlement rails. Deep pools, fast recycling, institutional traction, all gears turning together. In this case, adoption creates a self-reinforcing loop. Capital flows, increase depth. Speed amplifies utility. Locked tokens sustain scarcity, and access unlocks further demand. The market evolves from shallow volatile speculation into a functional infrastructure. Base case, most likely path if conditions stabilize. If adoption grows steadily but cautiously, liquidity improves incrementally. Tokens are locked in ETFs and DeFi pools at moderate rates. Settlement speed continues to matter, but adoption is patchy. Slippage decreases, but remains above traditional markets. Banks participate selectively. Some large trades move smoothly. Others face friction. Price rises in steps, not leaps, reflecting the balance of growing demand and gradual supply reduction. The network begins to function at scale, but inefficiencies remain. In this scenario, growth is structural but slower. The mechanics improve incrementally. Depth, speed, and access slowly reinforce each other. Institutional participants start using the network regularly, but only for transactions where execution risk is manageable. Market cap remains a poor proxy for real utility, but the liquidity index begins to reflect the network's functional strength. Bear case. What would change the trend decisively? If adoption stalls, pools remain shallow, and slippage stays high, the network struggles to absorb large trades. Regulatory uncertainty could tighten again. Tokens could become trapped in wallets or illiquid pools, leaving insufficient circulating supply to support real-world transactions. If price fails to adjust to structural demand, banks won't engage at scale. Settlement speed becomes irrelevant because the pool can't handle volume. Networks revert to speculative playgrounds with volatility dominating flows and functional utility suppressed. Large orders hitting thin order books could trigger cascading slippage. Trades meant to move millions lose a significant fraction in execution costs. Confidence erodes. Networks capable of handling billions remain theoretical, not practical. In each scenario, the key variables, depth, slippage, settlement speed, access, and effective supply, interact. The outcomes are not guesses. They are conditional consequences of observable mechanics. Adjust one variable, and the chain reactions shift. Understanding these interactions is what separates structural insight from headlines. First, the order book depth. Look at the bid and ask lines on major exchanges. How many tokens sit at each price level? How much volume can a $50 million trade absorb before slippage spikes? Watch it shift daily. Small gaps open, pools deepen or thin out. That tells you if the network can handle real money. Second, slippage on large trades. Not tweets, not headlines. Actual execution cost. If $5 million trades move the price 2%, that's structural friction. If it's under 0.5%, adoption is feasible. Track slippage across multiple exchanges to see where liquidity concentrates. Third, settlement speed. XRP settles in 3 to 5 seconds. Bitcoin, 30 to 60 minutes. Ethereum, 5 to 15 minutes. Faster recycling means the same pool can handle more volume. But speed alone doesn't fix shallow markets. Watch blocks processed, transactions per second, and confirmations per trade. That's where efficiency becomes measurable. Fourth, available token supply, institutional custody, DeFi pools, ETFs. Tokens leaving exchanges reduce liquidity. Track locked tokens versus circulating supply. Rising locked supply without corresponding demand increases scarcity. Falling locked supply signals potential sell pressure or reintroduction to the market. Fifth, regulatory access. Laws and guidance matter. Changes in custody frameworks or government clarity can unleash institutional capital. Keep an eye on announcements, filings, and compliance rulings. Access is the lever that lets the structural math work. Sixth, volume and market distribution. Where are trades happening? Are flows concentrated in one exchange or distributed? Are cross-border payments using these networks? High volume in a few nodes is risky. Balanced distribution indicates resilience. Finally, macro indicators. UST strength, treasury yields, inflation data. These don't move crypto directly like in traditional markets, but they shape institutional willingness to allocate capital. Dollars, settlement infrastructure, and regulatory clarity intersect with network mechanics. I watch these daily. Not for headlines, not for hype, for real-world function. Pools deep enough, trades executed cleanly, capital preserved. That's the signal. If these align, networks begin to behave like actual financial infrastructure, not just a speculative playground. Step back. Look at the mechanics, not the charts. Depth, slippage, speed, supply, access. They tell the real story. Market cap is just a label. It doesn't move money. It doesn't absorb trades. It doesn't matter when millions shift hands. Networks that function at scale do it because the math works, not because of hype. Tokens move fast, pools are deep, capital is preserved. Institutions engage only where the system can handle it. That's why monitoring liquidity, execution, and settlement matters more than any headline. Patience is essential. These networks evolve over months and years, not hours. Watch the signals, track the variables, and respect the structural limits. This isn't investment advice. It's simply how I'm reading the market right now. Focus on mechanics, not speculation. Risk management, discipline, and understanding how real money flows. Those are the tools that matter.